The following is a presentation of TFNN.
Hey folks, thank you very, very much for your patience. As always, it is Tuesday. It is time for TFNN and the Options Hour. My name is Victor Jones. We're getting started a little bit late here today, as you would imagine. A few technical difficulties, but we're back in Chicago from the East Coast. We were on the East Coast for about 3 weeks broadcasting there. We're now back, in the financial capital or baby capital of the world in Chicago, Illinois here, broadcasting just a few blocks actually away from the exchange. That's both the Merck and the SIBO, and an interesting day shaping up here. We're at 14.12 with a high of 14.19 and 3/4 made again today. And it seems like if you're looking at the candles, obviously we're down from the where we opened on the day, but we opened pretty close to the high. We traded up a couple bucks and now we are now sitting at 14.12.25. We're down 2 3/4 on the day. But again, we appreciate everyone's patience. We've got an interesting day in the market, and as promised, we've got a lot to talk about. We were talking to Tom just yesterday, about what's been happening with the VIX. We always come back to it, but as option traders, it's important that we know what's happening in terms of volatility. So we've talked about the S&P 500 here at 1412.5, touching a new high again today, a little bit lighter volume. But we're about right on par to do basically what the 5 or 6 day average in terms of volume in the overall market, at least in the SPOOs, and when I say the SPOOs, and whenever I quote the S&P 500, we're talking about the S&P 500 front-month futures contract. Now, again, we mentioned that funny term, the VIX, which is the volatility index of the S&P 500. So essentially, for all option traders out there, it's really essential for us, whether or not you're trading options, and if this is your first time listening, then welcome. If you're trading options, and even if you're not, if you're trading stock, but you're interested to know, hey, what tools are out there? How can I quantify market movement, potentially quantify market direction, potentially quantify market bias? These different things can be done with the options market. I'm going to encourage everyone out there, if you can, if you're in the Tiger Den, thanks for your patience for the last couple of weeks because we haven't been broadcasting the actual charts. And, again, that was a byproduct of us being out of town and on the road, but we're back again. And for those of you listening, obviously, feel free to give us a call at any time and talk to us about your positions you've got on. But before we get into any specific names, clearly we've got to talk about what's been happening with volatility. Now, we're at a 15 level even. We're up 74 cents. That's 5% on the day. Now, let's talk about what that means. In a day we are seeing the S&P 500 down only $3, which is less than 1/4%. Less than 1/4%, you're seeing an interesting move in the VIX. And why might that be? Well, you look around and you say, well, this isn't a Monday hangover, and what do I mean by a Monday hangover? Well, usually, what will happen is the market might be less inclined to beef up or add premium to options on a Friday as we go into the weekend. And why is that? Well, think of it from an option trader perspective. Think of it from an option seller's perspective. If the market or options were richer on a Friday, what could we do to take advantage of that? As we know, there's a saying in the options world that says there's 3 things certain in life, and that's death, taxes, and theta. Theta meaning time decay. So essentially, if I were to sell an option, there's something called theta. And theta is the amount of money that option decays each and every day. And essentially, if something's not essentially worthless or very far deep in the money, and we'll talk about those concepts, but if something has, essentially extrinsic value price in the option, it has theta. And so what happens is on a Friday, if something were rich or pumped up or priced up a little bit, you would, as an options trader, you'd be inclined to sell it because on Saturday and Sunday, as the markets weren't open, as the markets could not move, you're collecting that theta. So what happens is, you have this kind of bias to not really bringing up the VIX or volatility on a Friday because of that. So in a day like today where you see the market's not really down much, but the VIX is signaling something else. The VIX is signaling a little bit of fear, right? When you just look at a percentage standpoint, I mean, almost 5.25% up versus only being up, or excuse me, down 0.25% in terms of the S&P 500. You know, it's a very, I would say it's definitely a divergence, if nothing else, in terms of price or magnitude of move. So what's happening here? The market's telling us, hey, we're buying up a little bit of premium here. We're making new highs. The market's buying a little bit of protection, and that's essentially what this is telling us. Now, and that's one end, right, when we're talking about the overall market. But let's look at, quote unquote, what's really been, the story of the market over the last couple of you want to call it months, let's call it months. You want to call it expiration cycle, let's call it expiration cycle. You want to call it earnings cycle, let's call it any of that, because it's all of the above. And we're talking, of course, of Apple. Excuse me, I'm so excited here. We got so much to get out in such a short amount of time. We're already at 11:30 here on the Central Coast. We only got another half hour to cover, but we look at Apple, right? And we look at sitting at 425 going into earnings. We look at an earnings cycle that put out, $14 in terms of earnings, whatever it was. And you look at potentially, basically selling a market of iPads somewhere around 13 million in the last quarter, and then that market being basically projected somewhere around 60 million tablets, and then almost immediately after releasing a new iPad, that number, that projection comes out at something around 66 million. There's a lot of excitement going on, not only in terms of what they were able to deliver in earnings, right? And the expectation was to deliver 30 million units. They delivered 37 million units. So not only you have positive surprise on top of positive surprise. So you go from 425, you gap up $25, basically 5% into the 450 range, and it's literally been up and away since then. We've had maybe 3 days of really downward pressure here. 3 days of downward pressure, and now we're approaching again as the market makes a new high at 614.91. We're currently trading 613.91, basically $1 below what the high was on the day, but we're up another % on the day, almost $7 up on the day. So what does that mean? How can we take advantage of that? Well, bullish or bearish, it really doesn't matter. Let's take a look at what that old volatility index is telling us. So if you're lucky enough out there, and if you're smart enough, I should say, to be using the ThinkorSwim software, you can see a VIX style calculation on literally any underlying security that is optionable. If the underlying security is optionable, you can view the volatility index. So what's happening essentially over the last couple of days as Apple is making, I don't want to call it a basing pattern, because really, this is in terms of price movement, maybe not percentage, it's sort of a wide range we've been moving in, basically from 590 to about 615 here, so a full $25 of range basically over the last week and a half. But you've seen volatility move from right around 40% down to 32%. Now, here's what we're seeing. Now, think about this divergence here. Think about on a day where the market is moving down, the VIX is moving up, but by up in terms of a much greater percentage than what you might expect to see. Now you're seeing Apple continuously making new highs. They're not making as high of highs, right? You saw days in Apple where we would really move, $7, $10, just incredible moves to the upside in Apple. And today here we're sitting at 613.73. Again, a pretty good move here at 6 3/4. But the market is telling us, just in terms of volatility, in terms of uncertainty of pricing, they're getting more comfortable. And that's interesting, and I'll tell you why it's interesting, because the market did something similar a couple of weeks ago. It hit, 1377. It came off. It had a nice sell-off, about $15-20 in the S&P before rallying again to hit 1377. And the VIX, the first time we were at it, was at 18%. And what that means is that the market was expected a price fluctuation of 18%. And so the options were priced that way. 2 weeks later, we hit the same number, and the options are priced at 14%, meaning the market expects less price distribution. They're less nervous about where the market could potentially move. Now here, just a couple of days ago, essentially a week and a half ago, Apple was sitting here at 40% price distribution, or projected price distribution. Now we're sitting here at 32%, but we're making higher highs. And so the market's telling you, as we're making higher highs, but really staying in a really congested range, that they're getting less concerned about really where this level is. And to put that into perspective, basically right after we shot, or right after Apple made a move from that 420 area, we were in a low 20 VIX. So relatively speaking, we're still kind of in the middle of that range between 20 and 50. Basically, when we had to sell off the last time, when we moved from 420 to 350, right into earnings, you saw a move basically up to the 50 level. So we're really playing relatively speaking, we're right in the middle of a relative range in terms of volatility over the last 3 to 4 months. So what we want to talk about here is a few plays on Apple. How do we take advantage of not only what we feel our market expectations are, but how do we take advantage of some potential movements here in Apple? So let's just talk about, remember at the beginning of the show we mentioned, how do we quantify movement, quantify expectation? How do we take that 40 or that 32% number and turn it into something usable as an option trader? And that's what this show is really going to be all about today. And so again, we're sitting here at let's just call it $614. We've got a few, as option traders, we have a few options, quote unquote, right? No pun intended. We've got the March weeklies, which are set to expire in about 3 days. So I remember, in a world long ago when weeklies did not exist, I mean, the idea in terms of selling premium and selling options was that you were to look for something with 30 to 45 days to expiration. And why did you do that? Well, remember, we talked about that thing called theta, that thing called time decay. So if I'm selling an option, right, if I'm selling an option and I go out and I say, hey, I want to sell this covered call, maybe that's, on a covered call, for those of you, if that's a new term, let's say you own shares of Apple today. Let's say you own 100 shares of Apple. And you think to yourself, there could be a couple things you might think to yourself. You're thinking, hey, we're looking a little toppy here, or I'm nervous about the area that we are, or, hey, I'd like to sell Apple here, but I think I'd like to get a little bit better price for this. It doesn't really matter what that case is. I want to show you using what a covered call essentially would allow you the ability to do. See, we're sitting here at basically 613.50, but we made a high of almost 615, right? 614.91 today. So you almost hit 615. Let's say you were waiting on that perfectly round 615 number to get out of Apple, and that could be for any reason. But I'm really just thinking through strategy here. Well, I want you to look at this a couple of ways. I could put a sell order to sell at 615 and see what happens. If we hit 615, obviously I get 615 per share on 100 shares. That's $61,500. But if we don't hit 615, let's say we happen to only hit 614.91, well, what happens? Do my pockets get any better for that? Absolutely not, right? In fact, I've lost $1, actually $1.40 since that high point that we hit earlier today. I'm no better off for that than I was, before I submitted the order. Now, if you think of a covered call in a couple of different ways, one, in a way that we could actually generate premium or income for our portfolio. But actually another way is to think of it as potentially a working sell order that you might get paid on. Well, why do we say that? Well, if we were to sell the 615 April call, again, this is the April 615 call. Currently, I'm going to just, its value, it's $6.95 bid, $16.95, and $17.05 offered. So that's a 10-cent spread. If you take the middle, its theoretical value at the time we started this example, and even back to now, is $17. Okay, the 615 April call for Apple is worth $17. That's where it's trading at right now. So essentially, if I sell that call, what that does is gives me the obligation to sell Apple at 615 if we're trading at 615 or higher come expiration, right? 615.01. So at that point, I'm essentially obligated to sell the stock at 615. What happens if we don't get to that point? Well, if we don't get to that point, I keep the underlying shares of stock, but I also keep the premium that I'm selling the option for. So assuming I have $100, I'm selling a call at $17. In options, again, if this is the first time that you're listening either to the show or to the concept of a covered call, $17 means $17 per share. So you control 100 shares with each one contract. So what this essentially means on a $17 call, you are going to collect 17 times 100. That's $1,700 that you would take in for selling this call. Now, what happens in a day like today? Or let's fast forward on a day like today where I sell it at 17, maybe Apple waffles here at 615 or in between this 590 to 615 range. Maybe we even sell off. If we think about what this means, it essentially means I got $17 of price protection here in Apple. So if Apple were to move off to, let's say, if we take this down from 17 basically to 596 basically, I've brought in enough premium to offset a move down to 596 is what that essentially does. Now, that's I want everyone out there to understand that concept, because there's one case where if it goes above 615, not only do I get to keep the money that I would make, obviously at 615 or whatever profit, or I'll sell at 615, but I also, in addition to that, get to keep the $17 premium. Now, if you think about the two different ways, or the two different mindsets of thinking here, you're getting to a high area in terms of price. You're thinking, hey, I'd like, maybe 615. I'm thinking about getting out here at this level, but how can I maximize, or potentially maximize my exit? And if you've got a limit order out there at 615. What are the risks here about using this strategy versus a limit order? Because they are not the same. Let me emphasize, it's not the same. It's a similar strategy, similar mind frame, and potentially similar exit, but it's not the same. Because in one instance, Apple could quickly hit 615 and pull back, and you'd be filled on your order at 615. In this instance, where you're actually selling a call, you would need to expire above that level in order to actually sell that underlying stock at that price, or essentially be assigned or called away on that call option. So there are definitely differences there on how we can potentially we can potentially play those things, or how to think about those things. And interestingly enough, G7, Tom says, it's easy to play Apple. You just have to know what I'm doing, and you have to do the opposite, right? We have to. Sometimes it's easy to feel that way. But let's talk. We've talked about selling a call, but what we've done. A cover call is a schizophrenic strategy, really, because it says my main position, my core position is long stock. It doesn't matter, we're talking about Apple today, but that's only because, it's really, if you're watching the market, you're watching what Apple's doing. That's basically it. And in a day like today, you're having a little bit. It's interesting because the Nasdaq is having a little bit of divergence from what's happening in the S&P 500. And I think if you've been watching the market, the Dow Jones has been having some interesting divergences between what the S&P 500 is doing as well. Sometimes, and in most cases, kind of underperforming what the S&P 500 is doing. So we've kind of been watching that kind of relationship there, and as the market, the S&P 500 might be up $10, or basically up, let's call it 8% or something like that. You might see the Dow, 8% would be an extraordinary move. Let's say something like 2%. You might see the Dow at somewhere like 1.5, 1.25, and so the Dow hasn't, at least over the last couple of weeks, the Dow hasn't quite been as strong as the S&P 500. Now let's talk strategy here, and I would invite all of you in the Tiger Den, if you want to, type in some underlying securities. If we want to move on from Apple, if you've got something else you want to talk about, feel free to type it into the Tiger Den, and you can call us here if you're listening on the radio here at 877-927-6648. Again, that's 877-927-6648. Now, as you type those in or give us a call, I am actually going to jump in to kind of a strategy. Again, we talked about what would be a schizophrenic strategy, kind of is a delta hedge, because you're long delta, you're long stock, and you're selling a call. It's reducing your delta. It's reducing your exposure, your risk exposure. It's reducing your potential profit as well by reducing your delta, but also your risk to the downside. And that's what we're talking about by partial hedge. Well, let's talk about, what if I don't have Apple here? What if I don't have Apple and I'm looking to say, what happens if there's a pullback? And again, this is a show that we talk about strategy. We don't give, trade ideas or trade advice. We talk about strategy. So I'm one instance I'm talking about what if you're long, what if you don't have a position and you're bearish, and in another instance we're going to talk about being bullish here. So we're fair and we're balanced, but we're always talking about how do we use these strategies most effectively. So another idea here is we look at, let's go ahead and look at 20 different strikes here in Apple. The idea would be to come into this market at a premium. When I say premium, I'm talking about volatility at a premium that's it's relatively right in the middle of its range. It could be anywhere from 50 to 20 over the last 6 months, and we're right around 30. So we're at the low to mid range of where we've actually been. And so if we're looking at Apple here and we're saying we're sitting right at 615, is that at the money strike? As always, I love to pull up in ThinkorSwim this probability OTM number. And what does that tell you? And again, this is kind of one of those tips, one of those tricks that it doesn't matter if you're an option trader or stock trader. It's applicable to everyone, literally everyone. This column in ThinkorSwim actually tells you what the probability is, given the current pricing of the options, given the current pricing of the stock, given the days to expiration, what is the current probability that a particular call or put expires out of the money? Why is that important? Well, we're talking, at least so far, about strategies where we're selling premium. So we've talked about selling a call. We're getting ready to talk about potentially selling a bearish call spread here in Apple. So if I'm selling, right? If I'm selling this, this call. I want something again to just go over the strategy here. At 625, if I'm a buyer of the 625 call in Apple, well, I want, or my expectation is that we'll be above 625 by expiration. Now, there's more difficult than that because I'm going to pay a lot of money to have that call. So really, I'm paying almost $13 to buy a 625 call. Come expiration, it actually needs to be above 638 for me to be profitable, because I added the $13 I paid onto the strike price, and that's my break even. So on the opposite end, if I'm selling the 625 call, I don't want it to go above 625. I want it, if it stays below, I'm keeping the premium that I've sold for that option. So if I'm doing something like a bearish call spread, in this particular instance, I'll use these two strikes as an example. If I were to sell the Apple 625 call, the probability that it expires out of the money is a little over 61%. And those of you that can remember your calculus class, from maybe your first year of college or your last, some of your final years of high school, if you remember what 62% means in probability and statistics, it was problem stats. I'm saying calculus, it was problem stats. From problem stats, 62% is what's called a standard deviation. And if that sounds Greek to you, even though you're an options trader, if that sounds Greek, essentially what that means is that's the expected move. That's a simple way to say expected move. So if something has a 62% chance of occurring, that would be the expected move, or essentially 2 out of 3 times you expect that to happen, right? So we're looking at a 625 call in Apple, and we say 2 out of 3 times we'd expect to be trading lower than 625. That's hard to do right now. I got to be honest. Apple's one of those things that I look at the chart, and if you were a contrarian, that's a very intriguing chart to try to take a contrarian position. But you have so many of these positive forces in Apple, coupled with so little competitive, I think. Competitive, what's the word I'm looking for here? Let's just say competition. Let's make it easy, right? I mean, RIM's kind of waffling right now. You have Google, which is doing some really good things, but not taking advantage. They're waffling in terms of the device, so to speak, and they don't have the same market share, especially in the tablet space. So, Apple's really well positioned, and these charts look parabolic, but they look parabolic because you just saw they blew away the street in earnings, and they're blowing away the street's expectation in terms of new devices. The elasticity of demand meets their ability to produce these devices. So I'll get off the soapbox for a second. We'll get back to the strategy. So again, if I were to sell the 625 call at $13, what does that mean? As long as we're not above 625 on expiration, I'll keep the 625. But if I do that and I don't own the position, I have unlimited risk, because at that point I'm obligated myself to sell at 625, which means I have to buy the shares. I have to cover them. And the way Apple's moving today, it's very difficult, right? It's difficult to say what price might you have to cover in Apple, and as we know in math, there's no upside limit, there's no upside bound here. There's log normal distribution in the market. We can go down to zero, but there's no cap on where we can go up to. So what that essentially means is, at 625. That's my probability of occurring is 62%, but on the off chance, or on the chance that we do move up, that 38% chance that we do go above 625, I don't know what my risk is. So what traders or what option spread traders will do, or what a bear call spread calls to do, and why it calls to do this, is potentially buy the 630 call behind the 625 call. What does that do? Well, essentially, it limits my risk. It also limits the credit that I'm going to take in. So right now, if we were to evaluate that spread, it's a 5-point spread, and I get about $1.80 to do this, $1.85. So if it's 5 points wide, I take in $1.90. Let's just round it off. Let's say we work really hard for execution. Actually, 185 is a little bit more realistic. So 185, it essentially means to have $3.15 of risk on the table. I will bring in $1.85. I'll be risking $3.15. That's it's basically, I'm not quite 2 to 1. I'm basically 1 to 1 3/4 or so in terms of risk. But what you're seeing here in something like that is now I've capped my risk. Well, how did I cap my risk? Because I bought the 630 call, and what does that always allow you to do? It allows you the right to buy the stock at the underlying strike price. So I sold the 625, right? I said, as long as we don't come above this level, I'm going to take in a credit. But I also bought the 630 behind it that says if we do happen to go above 625, I'll always be able to cover it at 630 because I own that 630 call. So essentially you've maxed out your risk at $5, which is why that's a 5-point spread, and why your risk is really just $3.15. Because remember, to sell the spread together, there's a net credit that you'll receive of $1.85. So that's why your real risk here is $3.15. So these spreads, or spreads in general, are a way to limit your risk, especially in credit spreads, are a way to limit your risk, right? A way to limit your potential risk in the position. Now, what happens when you limit your risk? Well, you limit your upside potential. Whenever you sell something, you can never bring in more than what you sell it for, right? If you have a garage sale, lawn sale, it doesn't matter. You can't sell the TV or the family heirloom. You can't sell the family heirloom at a couple $100, and then maybe you see later on down the road at one of those antique road shows or whatever the case is, that, hey, that's actually worth $500. That's because it's worth $1,500, and go to the guy you sold it for and say, hey, that thing's actually worth more than I thought it was. Can you pay me the difference? I mean, in today's marketplace, it doesn't work that way. So it's a very similar concept in the option world, in that you'll never get more than what you sell something for. If you're selling to open something, just if you could write that down, or just take a mental note in the option game. If that's something that's new to you, you'll never get more than you sell something for. If you're selling to initiate a position. So at first we said that we're selling at 625. We'll have the potential to bring in, $13. Well, this is no $13. This is no $1,300 if we were to do this the one time. This is $1.85. This is $185 instead. But instead of having unlimited risk, we've capped our risk at $315. So there's a very big difference there. If you want to limit your risk, you obviously have to limit your upside potential, the potential gain. Everything in the market, especially in spread trading, is a risk trade-off. I mean, that's all it is. You know, it's no coincidence that the calls that are further out of the money have a lower probability of success, right? If I were to tell you today, if something's worth $100, what do you think the probability of it in doubling in price is in a year? You might give me one probability. I say, what do you think is probability of doubling in price in 4 years? You might give me a little bit higher probability. You have more time for that to occur. Or if I say tripling in price in the same amount of time, you'd say a lower probability. You know, probability is really a function of time, and so is volatility. It's a function of time. So as we go in, let's go ahead and do a quick market wrap-up before we really bring it on home. We'll do a quick, bearish strategy here, but I wanted to quickly give a market cap a market recap rather, not market cap. If we want to talk market cap, let's talk about Apple. If we want to talk market recap, let's go ahead and talk about the S&P 500. We're currently at 1411, down $4. So we gave up another buck or so since the last time we quoted. That's not really surprising. Why is that not surprising? Well, we just looked at the VIX, and we said the VIX is telling us that either people are buying up too much protection, either the options are really rich right now, or the market, the people are buying up protection, and the market's not really responding to that. So the fact that the market has come off just a little bit as the VIX is rising disproportionately to the underlying market is not surprising. If we take a look at NQ, obviously, and that is, again, the NASDAQ 100 Index Futures, 2784, up $7 on the day. So, again, you're seeing that divergence between what's happening in the NASDAQ, like I mentioned earlier, what's happening in the S&P 500. At NASDAQ strong. Why is it strong? Well, again, if you're watching the market, you're watching the NASDAQ, you're watching Apple, and Apple's up significantly today. And let's just jump in to one more. Obviously, if you're a follower of the Dow, we've got a quote /YM on the ThinkorSwim software. $13,168, down $33 today, which is about 0.25%. And so that's right on par with what you would expect to see in terms of the Dow and the S&P 500 relationship. So as we wrap it up, let's look at quickly just one more thing with Apple. It's the same concept, the same idea. We're looking at probability out of the money. Now let's say you're bullish, you don't have a position. Okay, we've talked about bullish have a position, bearish don't have a position. Let's talk about bullish don't have a position. Okay, if we're using that same concept, again, selling premium here, and that's all we've talked about. There's another way to play this, right? There's another way by buying premium. We haven't talked about those strategies. We've only got an hour, and I can only talk so fast. So that being said, we've talked about premium generating strategies here. Even at a low VIX, you're seeing a relatively decent number here with Apple, and that's why we've talked about it. Now, from a strike perspective, if you've got the probability of OTM, where are we searching for? Well, anywhere between the 600 and 595 area is really where your 62% lies. So it's really how aggressive do you want to be? And I think 600 is going to be a heavy psychological number if Apple did want to pull back. So let's go ahead and pick the 595 as a more conservative strategy here. And again, I'm just doing this as an example. You bring in $1.52 to sell that, which means you have $3.50 of risk on the table. And your probability, again, that you come down and hit 595 is about 65, or basically that you don't come down and hit it is 65%. The probability that it does is 35%. So basically, you will take in $1.55 to do this, and we're currently trading at 614, and your break even is right around or a little bit below, basically 593.5. And so 593.5 is, we're significantly away from where we are today, right? We're maybe $20 away or so. It's $20 away from the current market is, which is about 3%. It's a 3% cushion in terms of price, and if Apple waffles where it is, and we're somewhere in between a relative range of 3%, you'll make money. If Apple rallies, and it doesn't matter if it's $10, $2, or $20, you'll make the $1.55 at least from now until expiration. Again, we're talking about the end game here, always at expiration. And if it sells off, as long as it doesn't sell off below that 593.5 level, you have the potential to still bring in that $1.55 or some portion of it from now until expiration. So I know we flew through it. We got a little bit of a late start, but I think so many people in Apple is basically all around you. right? Apple is all around you right now in the news. Tech is all in the news, and especially on a day like today. I mean, you're liable to turn the TV off at the end, as the markets close. You're liable to turn TFNN, or Tom comes on and gives you his market wrap-up. And what are we most likely to say in a day like today if we keep going where we're going? Well, the S&P was down. The NASDAQ was up. Someone has to explain that difference in relationship there, and we're likely to say Apple's strong. Well, why is Apple strong? And that's going to be your news article. So to understand really those strategies that we could take going into April expiration, I think is really, really important, and that's why we spent the last 45 minutes talking about it, but we also talked about the market in general. Until next time, we will be watching, as always, the S&P 500 and, of course, the VIX. And I encourage everyone out there to keep your eyes on probability. And we'll see you next time right here on TFNN, the Options Hour with Victor Jones. Thanks, everyone. Have a great week.